Hello, everyone, and welcome back to the Friday Musings with Jay Pelosky. It's always a great thing to have Jay here. How are you, Jay?
Pretty good, Scott. It's been a fairly quiet week on my end. How about you?
Yeah, nothing really much going on at all. Before we jump into
Exactly.
the show, don't forget to click.
Powell, who's he? The Fed? What? Who cares? Inflation?
Before we jump into this. Before we jump into the show, Jay, get everyone to click on there and subscribe and all those sorts of things, all that
Exactly.
usual stuff we have to do. But we're looking forward to jumping into the show because your musings is right up my alley. It's titled Like a Hurricane, and I presume you're just referring to Rock Me Like a Hurricane from the Scorpions in the 80s, no?
Who and what? No, dude. Neil Young, okay? We go back OG, not any of your, copycat people.
80s
OG.
hair music, buddy. 80s hair music.
Oh, yeah, exactly. Well, you got the hair. I mean, more power to you. But I'm talking about Neil Young and Crazy Horse back in 1977, because it struck me that people were talking about the collapse of Silvergate and the implosion of Silicon Valley Bank as akin to the savings and loan crisis of the 80s. And so to me, it like flashed in my head as I was thinking about what to write this morning, like a hurricane. And to be frank and to be honest, Live Rust, which is Neil Young and Crazy Horse at that time, is one of my kind of go-to albums to listen to when I'm at the gym. So I have heard Like a Hurricane recently. I think it was 2 days ago. And all of a sudden, here we are in the midst of a hurricane as the crisis within these kind of crypto bank VC space has upended everything, even the jobs report, right? I mean, much less important than what's going on with Silicon Valley Bank. And so, to me, the title kind of speaks both to the idea that this is akin to the '80s, as well as the actual kind of out of nowhere. Just as you're sick and tired of the inflation issue and trying to digest Chair Powell's comments, boom, clear that all away, blow it all out, and let's focus on crypto banks and venture capital guys and what it all means.
I have to admit, I've still got Rock Me Like a Hurricane ringing through my head right now.
I can't help you there, my friend. I can't, what's in your head? I'm not even sure I want to know, frankly.
I don't think anyone wants to go in there, not even me. But all right, let's look at this, right? It literally has been panic stations earlier this morning. Like we've seen these sorts of things before on the market. And in your musings, you refer to the LDI crisis in the UK. Now, not that we're going to get too deep into that, but can you define what an LDI is or what the definition of LDI is, but then
Sure.
also make that comparison between like this morning?
Sure. Liability driven insurance is LDI, and that's about as far as I know. And don't want to go any further. I'll be honest. I learned a long time ago not to pretend that you know stuff that you don't in this business, because as soon as you do, somebody calls you on it, and then your credibility is totally blown. So I learned that the hard way back in the day, and I don't do that. So that's about all I know. But my point is not so much the intricacies of LDI, but that I think that the Silicon Valley Bank crisis here, mini crisis, is going to be very similar to the LDI crisis that affected the gilts market, which is bonds, like our treasury market in the UK last fall. So, as a quick reminder, last fall, out of the blue, the UK bond market or gilt market blew up because people were mispositioned due to this liability driven insurance or LDI. And it freaked people out, and the stock market fell significantly over a period of a couple of days. I was actually on Bloomberg in the midst of that and called it a tempest in a teapot in real time. And that analogy has stood up because now, if we look back over the last several months, the UK has actually been one of the best performing developed markets in the world. Okay, so we've forgotten completely about LDI, even though for a week or two it was like the center of attention. And while some people are calling this a crisis, and others are reminding us of the savings and loan crisis of the 80s, I think this is unlikely to expand to take in more of the bank sector in general. Basically, because this is a very specific issue, namely both Silvergate and Silicon Valley Bank deal with the crypto and VC space almost completely. And so that space has obviously been nervous and taking money out, using their cash pile, because it's been very hard to raise new money, right? Given the environment over the last year. So the folks that are pulling their money from Silicon Valley Bank are A, very worried about cash burn, B, very nervous about their cash pile, and C, when respected Silicon Valley VC guys suggest to take some money out of Silicon Valley Bank, that's what they're doing. So it's effectively like an old style bank run. And there are very few banks that cater to that such a specific slice that is already kind of on tenterhooks and ready to move immediately, given that once that cash runs out, they close, they're out of business. So that's not the normal depositor. And I know there's a lot of talk about banks and having a lot of available for sale securities that are underwater. And if they have to sell them, they'll take losses. I get all that. But to me, I think there's a fairly reasonable chance, more than a reasonable chance. I think it's quite likely that this is going to end up passing. And much as the Bank of England put a blanket over the LDI crisis last fall in the UK, I would expect that Silicon Valley Bank probably is going to be sold over the course of this weekend, because they do have a valuable, very valuable franchise. And they've just been caught in a basic bank run where everybody wants their money. We all know that banks don't have everybody's deposit money available for withdrawal. They lend it out, et cetera, et cetera. So I would expect this to kind of fade over the near term. And I would just remind people of a couple of different points to focus on. One is, prior to this news, right, the AAII investor sentiment was already at its most bearish level, record bearish level, right? Lipper tells us that for the last 9 weeks, U.S. equity mutual funds and ETFs have had outflows, the longest such streak since 2016. And then third, and finally, the regional bank index, I just checked before we got on together, KRE is now trading with an RSI of 17, okay? Extremely oversold, right? Even XLF, which is the big bank ETF, is trading with an RSI of 24, significantly oversold. So I think we're closer to the end than the beginning. We've already had 9 weeks of outflows, most bearish sentiment ever, extremely now oversold bank ETFs. And that's not to say that what's happening with Silicon Valley Bank is bad for them and bad for their depositors, but we're talking about systemic risk. And I don't think we should really be worried about systemic risk.
Just as a sidebar, like just before you came on to do this, and we're recording this around noon on Friday, there was a headline that came through that Silicon Valley Bank is shut down by regulators, and the FDIC is to protect insured deposits. So there's going to be a lot of definitely news coming out over the weekend, that's for sure.
Yeah. And as we talked about at the top, right, completely blew away the focus on Chair Powell, completely blew away the focus on the jobs report. But when I think about it, Scott, I think about, the jobs report came in, kind of pretty benign, right? Higher jobs number than expected, but job participation rate picked up, which is very good, right? More people coming in to the workforce means less pressure on wages. And lo and behold, wages went up less than forecast. That's also kind of good. And so that also kind of dovetails with a significant rally in bonds, right? We had huge moves. I mean, the 2-year when it was heading to 510 and now reversed, and in the space of a day and a half is around 4.8. I don't even know where it is exactly at the moment, but when I checked this morning, about 4.8%, 30 basis point move. The 10-year, which was breaking through 4, now at 380. The market, which was focused on 50 basis points at the next Fed meeting, now talking back at 25. The dollar, which was surging, now kind of coming back in as those rate hikes are reassessed. I actually think that on the short term, yes, we're taking some hits here, but on the medium term, that's a pretty decent trade, right? If the combination of a good job, a decent jobs number, and concerns over the financial system, even if misplaced, leads the Fed to raise 25 as opposed to 50, caps the dollar, and allows the market to start continuing to focus on how things unfold over the next several months, as opposed to worrying about the Fed is going to do 50 and has to crack stuff. And maybe this is a crack in the market, right? We've been waiting for something to break. Okay, but now we have SVP being taken out by the regulators. So something is broken. That could actually be like a cleansing issue as opposed to a deeper issue. And so to me, the short-term versus medium-term trade here is actually pretty good. We have a couple of days of volatility in the market. We clear out anybody who wants to sell, right? I mean, it's selling here big time. I mean, I looked, as I said before, KRE was trading, it already traded 75 million shares, more than double its average by like 10:30, 11 o'clock this morning. Yesterday's volume, by the way, was 8 times the daily average. So when you read regional bank index down 8% in a day, also read that there was 8 times the average volume. So it's the old story, right? When you try to get an elephant through a keyhole, the elephant's got to shrink. And so lo and behold, price has to come down if you want to satisfy 8 times your daily volume in a single day.
Well, that brings us to, like, obviously we did the monthly last week and so forth. And obviously you change your model, do a few tweaks here and there, and everyone loves to hear about your little tweaks. So let's talk about what the updates for the model.
Well, as a quick reminder to folks, right, we do our musings every Friday, and then at the end of the month, we do our deep dive monthly, which was last week, 4,500 words, 20 plus charts and tables. And then this week, we update the models. The idea being that we put everything together with the monthly, so it's all coherent in our heads, and then we go ahead and update the model. And so we did that this week, and you know what? Last month, we did nothing. Very, kind of rare. We made no changes, basically because everything was overbought, right, after the January surge into early February. So we didn't do anything. This month, as we just talked about, some things are becoming very oversold. And so we did make some changes. And our thesis, basically, and we kind of started to develop this in the monthly, and we're going to continue to develop it because I think it's really, really the key issue is that beyond SVP, Silicon Valley Bank, right? Beyond even the inflation saga, which just seems never ending, right? We think we're coming to the end of that at some point in the next several months. By mid-year, we think the Fed's probably going to be on hold because we do think inflation is going to continue to come down. Behind all of that, there are some huge policy changes taking place around the world. And we want to use short-term market dislocation, like this week, to build positions in instruments we think will benefit from those huge policy changes, right? And one of those huge policy changes is we're going to shift this year from rate tightening, one of the most aggressive rate tightening cycles we've seen in 40 or 50 years, to a cutting cycle. That's one. Another is the full embrace in the US of industrial policy, CHIPS Act, IRA, Infrastructure Act, for the first time since the 1950s. And the third is the explosion of AI and what that means for work and who does the work or what does the work. And then fourth is China's going for growth, right? China making the move away from zero COVID and going for growth. We think that is going to kick off a new global growth cycle. And it's so interesting, Scott, because people are not talking about this, because every time we try to pick our heads up and look into the horizon, you get slammed with something like what we've dealt with this week, right? SVP, or you get slammed with Chair Powell's testimony, or you get slammed with the strong January jobs number. Really important for investors to try and look beyond the day-to-day and understand that things are unfolding in a major fashion, in our view. And so we are positioning for those things. So robotics, automation, nearshoring, our tripolar world focus on regional integration. We added to some countries on that basis this week. We added to robotics. We added to semiconductors. Semiconductors are the foundational foundation for AI, right? AI uses huge computing power. Semiconductor chips are the foundation, right? Electric vehicle expansion. Tesla just talked about it, putting in a new plant in Mexico, right? What do electric vehicles use a ton of? Copper, right? Copper is in the doldrums because people aren't sure what is going to happen to global growth. Opportunity. So those are some of the moves that we made this week, looking at things like robotics, automation, AI, nearshoring, and trying to take advantage of the dislocation generated by tempest in a teapot like SVP, and use these sell-offs to put money to work, right? Wall Street is telling you, hey, you should be raising cash. Cash is going to be a good thing. I read a Bloomberg survey that said 2/3 of its respondents think cash is going to bolster their returns for this year. That was last year's trade. Cash would have been a great thing to have lots of last year. I don't think it's going to be a great thing to have lots of this year, right? So instead of raising cash on a day like yesterday, we want to be putting cash to work, because you have an opportunity to buy stuff all of a sudden significantly cheaper than it was the day before. And so I think that's the way we've been approaching it here at TPW Advisory. And we think that over the medium and long term, we're going to have that high nominal growth rate environment driven by a global CapEx boom that we've been talking about for almost a year at this point. We're getting up on a year of talking about the middle way and the high nominal growth world and the CapEx boom. So that's what we did this week. Today we're down a little bit, obviously, from yesterday, but we're looking out next 3, 6, 9, 12, 24 months. And I think we're going to be higher, much as the UK in the midst of its LDI crisis was down over a period of weeks, but over a period of 5 months, it's up over 20% from those lows. And so that's how we're seeing things. And I end my musings with a line from the song "Like a Hurricane." You are like a hurricane. There's calm in your eye. So our advice to investors is to keep calm and carry on.
Well, thank you very much for that, Jay. My advice to you is to go check out that Scorpion single, "Rocking Like a Hurricane," as well. I think it was 1984 that might have come out.
All right, my friend. I because it's you, I will actually do that, and we'll see. But I'm Live Rust is a pretty kicking album in my view. So we can debate that as we debate the markets, perhaps again next Friday. But great to see you as always.
Great to see you as well. Thanks very much, Jay. And for everyone else watching, don't forget you can go to Pelosky.com to sign up for Jay's musings and much more. Until next time, good luck investing.